Amid the surge of the second wave of the coronavirus, India's IT industry has been dipping off in exponential numbers. The engrossing repercussions of the initial wave and the road to recovery have been somewhat identical to the global financial crisis. Revenue slashed 6 to 7% subsequently after the pandemic ramifications and calculated a slight recovery over the past year. Today's scenario is disastrous, and expecting a significant rise in the valuation of the IT industry would be bewildering. The impact of the COVID-19 pandemic has stalled the progress of numerous sectors across the nation. The situation is a remnant of the global financial crisis, as the recovery following the initial lockdown was similar. The prima situation today could be analyzed by citing a stellar example for the same. Inevitably, we have taken the three prominent forces of the Indian IT sector for growth prospects. For instance, if we compare the global financial crisis recovery pattern, we would oversee a protracted growth in the IT industry. Following years after the crisis, Tata Consultancy Services Limited, Infosys Limited and Wipro Limited had surged to record growth patterns estimated at 45%. The levels couldn't get matched if the company doesn't inculcate $5.2 million in quarterly revenues in the next 2 years. The crisis has exceeded a burdening loophole across the IT industry, and it is uncertain when the growth rates will endeavor the pre-pandemic levels. The captivating growth across various levels got driven by the sanctions of gigantic deals in the IT industry. According to analysts at the Kotak Institutional Equities, they have suggested a compounded growth of 3% for the next 2 years, which is massively lower than what the conglomerates expected. The lowest breaking point for the companies got recorded between the March 2010 and March 2012 quarters, and the present synopsis explicitly has surpassed every level of recession. The throttling of unemployment has further declined the empathetic boost of the Indian IT industry, and they haven't overhauled the situation by the grip comprehensively until now. Last year, during the third quarter of 2020, TCS announced the merger of the Post Bank Systems AG (PBS), the captive IT service provider of Deutsche Bank AG. The expectation around these deals has been regressive due to their margin dilutive reaction. It is unlikely that the same level of apprehension could get achieved given the hastenings of the nation amid the second wave. As states have instilled a partial lockdown and the majority of the population underlining the threat of the pandemic, the companies can't expect a change of stance in the next 2 years. The heavyweight reliance and backing of the investment management services by the companies might have lifted all the boats, strangling the growth. For instance, the Nifty IT index has surged past the record pre-pandemic levels in the recovery process. The argument that has popped up over the past few weeks is whether the growth charts will be sustainable amid the turbulence of the second wave. The concerning dilemma under the helm of the Indian IT industry is regarding the hiring process. The COVID-ravaged impact got overseen in the hiring process, as it temporarily shut down firms are struggling to hire skilled recruits, as there is a pent-up demand for jobs, but the job aspirants are ailing from the repercussions of the tormenting infection crisis across the nation. Although the training and the reskilling programs can help to combat the affliction, they might not be enough to meet up the demand of experienced digital talent such as senior cloud architects and AI researchers. The shortage in the know-how of all digital adroitness is also posing a problem within the Indian IT industry. The overhauling stance of the Indian IT industry post the initial wave has been surprising despite the few concerns arising over the past few months. IT stocks have been the most advanced in the recovery period, but whether the growth could get endured will be seen in the reporting of results of the second quarter.